just want to thank everybody for being here and for trying to get here as closely as to on time after lunch and the coffee. But first of all, I'm going to introduce our moderator, who will take care of the rest of the introductions. I'm very pleased to have Antony Bugg-Levine here, who is also an adjunct professor at CBS. Okay. And today is also Antony's last day as the head of the Impact Investing Initiative at the Rockefeller Foundation. He's also the co-author of Impact Investing, Transforming How We Make Money While Making a Difference, which was recently published, co-authored with Jed Emerson. It's a great book. If you have a chance to check it out, it's available for sale on Amazon. And in 2 weeks, Antony will be starting a new role as the CEO of the Nonprofit Finance Fund. And without further ado, I'll hand it over to Antony to get the panel begin.
Thanks, Sean. I think we'll do this way. Sorry. I asked Sean to plug the book so I wouldn't have to, so it's not his fault. But really excited to see everyone here. I said to the panel earlier, I find the most useful way to start a panel is by insulting the audience. So what are you guys doing in here and with no windows on a beautiful afternoon like this, listening about impact investing when you could be out there in the beautiful courtyard? But we're glad you're here. I'm not going to spend a lot of time on introductions. I always feel like most of the panels, when I speak, people know how to read and you know where to find the bios if you want them. Other than to say that we have a really great panel of people who have not only been real leaders of this whole field of thinking about how we can use investment capital productively to address the world's problems, but in different ways have all been practitioners and people whose insights have been hard-earned through practice and not easily earned just through rhetoric and writing, like some of us. So it's really great to welcome the panel here, and I'll ask them, as they talk, to describe what they're doing in the context of some of the questions that are going to come up. The general theme of this panel is to really think about this idea of how do we use for-profit investing and entrepreneurial business models to address the world's challenges. But I'm hoping that the panel can do it in a way that's both generally easy to understand, but also gets beyond some of the introductory 101 kind of conversations that many of us have been having for the next few years. So I think in the next hour or so, I'm hoping that this panel, through some provocative conversation, can really get to the next level of insights around this question of, if we start with this idea that a for-profit investment can be both a morally legitimate and an economically effective way to address social problems, that's a great starting point. But once we have that realization, then huge complexities face the people who are really trying to make that happen. And I think the people on this panel have a lot to say about not only what is the potential in impact investing, but also the challenges in making it happen, and the real practical work that goes on the ground to deal with some of the non-trivial and often glossed over trade-offs and other nuances and complexities in this work. So with that, and just the last thing I'll say is, as Sean mentioned, in the brochure it says that I'm with the Nonprofit Finance Fund. I will be in a few weeks. I'm currently, for the next 62 minutes, still an employee of the Rockefeller Foundation. So by the time this panel ends, my email will be shut down, my hard drive will be wiped, and I've already handed in my security clearance. So I couldn't imagine a more interesting way to spend my last hour than with this panel and with you guys. So with that, I want to just turn it over to Steve Beck. And Steve is someone who has spent a career both as an accomplished executive in companies and working and consulting to companies, developing strategies to make money selling products in emerging markets, and also has worked as a philanthropic advisor. So he's someone who's been on both sides of what in the book we talk about as the bifurcated the world in which on one hand you make money, and the other hand you give money away to solve problems. Steve's been in both. And so my question for you, Steve, is based on that background, why are you now, through your work with Spring Hill Partners, trying to take a different approach of really integrating those two ideas into an investment firm that can address social challenges?
Well, the short flippant answer is it's a great outlet for my pathological schizophrenia. But yes, as Antony said, I spent 20 years in strategy consulting, investment banking, and then 6 years in sort of the professional grant-making space. And now Spring Hill Equity Partners is making investments impact investments, I guess we would say, in East Africa, looking to fuel businesses that are providing basic products and services to low-income households. And so why, kind of, on the one hand, this filthy capitalist, doing evil things and making money, and then doing great things and saving the world through philanthropy, and why this sort of halfway house in the middle? I guess, for me, it comes down to the ability to combine some things, to combine a better way of making an impact with a kind of expression of my own personal values and beliefs, and being, I think, a better steward of capital. The contrast that I think I want to draw is more with the philanthropy side, the pure grant-making side, and the impact investing that we're doing now. And I'd say there are three advantages to the impact model, the impact investing model, the for-profit model. One is dignity, the other is sustainability, and finally scalability, which is related to the second. So what do I mean by dignity? So we were, I think, doing a pretty good job of applying an investment discipline and rigor to grant making, and seeing real lives change on the ground and so on. But the reality of being in that grant-making space is there's a real unevenness to the relationship. Even our language belies that, right? We talk about benefactor and beneficiary. Even the language of empowerment implies that I have power and I'm lending some of it to someone else. And however hard we tried to kind of be partners and to honor that dignity of the recipient of the grant and the beneficiaries of the programs that we were granting to, the reality was there was still this unevenness. There was a tendency to create dependency, and frankly, for our side, there was a tendency to fuel our kind of messiah complex. This idea that we were saving the world, we were saving kids, we were saving people from diseases and so on, and so we saw that. And whenever I traveled in Africa, I was like, I was the Mzungu with the dollar bills hanging out of his pocket, and I was the hope. We were the hope, rather than the people on the ground, the people who are doing the hard work. So dignity, I think, now when we're talking about partnership, we are partners, right? We're making equity investments in businesses. We are legal co-owners of the business, and our fortunes rise and fall with the entrepreneurs and the business and the consumers who indeed have the dignity of making choices, the employees who have the dignity of having a job, being able to provide for their own needs. The second two things, I'll be more brief on these, are sustainability and scalability. So the wonderful thing about a grant that's being effective is it is being effective, lives are being changed. The difficult thing about it is the money runs out, and they've got to come back for a bigger grant, and it's a scarce pool of capital that they're coming to. The wonderful thing about a good business is that it generates profits and it can fuel its own growth over time. And therefore, the third thing can happen. That is, you can address problems at a much bigger scale. So dignity, sustainability, scalability.
Great. Thanks, Steve. And we're going to explore how you actually achieve those. They're great. They're very interesting targets and an interesting aspect of when this work is done right. But what does it take to do the work right is an interesting question. And before they get that, I wanted to turn to Rick Defieux. And I think a lot of times when we talk about impact investing, and I don't know about for you in this audience, but many people associated with the kind of international development work and the focus on Africa and other areas of the world where it really is around generating income and creating economic development. And I think Rick, through your work with SJF Ventures, have interesting insight on how this work has been and this tool has been applied within the US context. And so I just wanted to start sort of describing how SJF Ventures thinks about impact investing, and specifically, what does it mean in the US context where it's not just about getting people out of poverty, but other aspects of what is it that you guys aim to do on the impact side?
Great. So first, I'll mention a bit about my personal transition, similar to Steve's. So in my case, after I left here in '84, I was what Anthony would call a mainstream venture capitalist for 20 years or so with Edison Venture Fund and others, doing primarily clean tech investing, it was a fairly small club. In 1999, co-founded with Dave Kirkpatrick, SJF Ventures, And before I answer your question, I'll give you a little bit about our history because it's interesting in relation to this new category of impact investing. So basically what I've been doing for now almost 30 years is impact investing, but the name didn't exist. And the reason we started, and I actually still do mainstream venture with most of my time, and I'm part-time at SJF, unlike all the others there. But we started SJF to do values-based investing, to make a venture return, but also make a difference. And the reason we did it and I didn't continue strictly with mainstream funds was to invest with similar values-based individuals, but also to create a vehicle, and that's kind of the interesting part, a vehicle for investors that thought along those lines. And it was a very different environment, I'm here to tell you, in 1999 when we set out to do this. And in fact, we didn't set out to do what we're now doing. We did what you in the philanthropic world would call PRIs. We said to the world, and remember it was a very different environment in 1999. Venture capital in the US was reaching its peak, $100 billion a year in and out. It's now a seventh of that, an eighth of that. It was a 20th of that when I started. So it was peaking. You could not, I couldn't with a straight face go out to people I knew in the banking world and say, the world needs another venture fund and we're going to get you a venture return. The venture industry was, you had to say it was efficient. It was more than efficient. It was funding way more companies than could achieve a venture return. So we went out and said, we're going to make some things happen that aren't happening today. So we're going to relax the return standards. And this story resonated with the banks at that time. Didn't for very long, but at the time it did. And so that was our roots. And in fact, and there was no impact investing. And so the question is, well, what were we? We even had a different name then. But we were, some people called us community development venture capital. Kerwin Tesdale has a CDVCA here in New York, and they do a great job. But it was not a good name for what we did. The name comes with a lot of baggage that evokes images of losing a lot of money for reasons we won't get into now. But that industry had not been successful. Then there was SRI Venture Capital. SRI is obviously an established term elsewhere, but SRI Venture Capital didn't really do it for us either. Socially responsible, I never liked that because it implies that, and remember I spend most of my time in mainstream, it made it sound like everything else was irresponsible, which wasn't good. But it was also negative screening. It wasn't what we do. We target. We don't screen, we target. So anyway, now impact investing came along. We love the term. Thank you.
You're welcome.
It saves us 10 minutes explaining to people what we do. You can get right into talking about how we do it and why it fits with them. And later we can talk about, we're out actually raising another fund, and I can tell you kind of how the various constituencies out there are receiving us.
And his lawyers wanted to know that was not a solicitation for investing
right.
for non-qualified investors.
Right. Ditto the book thing. But I guess the last thing I wanted to say, finally maybe answer your question a bit. So we're domestic, and we're basically doing what we've done for 12 years and what I've done for 30 years. But 2/3 of what we do is clean tech. Another third is, you might call tech-enhanced services with health and education and similar social benefits. But we're not domestic in another sense, because the clean tech, the clean energy industry is absolutely global. It does not matter where emissions derive from. It also doesn't matter where the solutions derive from. We're all in it together. So it's a very global industry, and we consider ourselves, we're all in it together when it comes to the kinds of industries we're investing in.
That's great. Well, thanks so much. It's really interesting to hear about how it's evolved and the context in which you operate has changed. And I want to come back after we hear from Ben around when you described that we're trying to make things happen that aren't happening now, which in the book we describe as additionality. And a question to the two of you would be, how do you find additionality, and how do you balance between chasing the deals that truly are additional, but also not just dealing with the bad deals that no one else wants to fund for really good reasons? But before we get there, I wanted to just hand over to Ben Powell. I think a lot of you might know Ben. He's a relatively legendary CBS alum who left from CBS and did something quite unusual, which is rather than just talking about this while pursuing a safe mainstream career, he actually put his family's wealth and his own professional reputation at risk to try and make this happen. And so I wanted to ask Ben, first of all, do you still think it was a good idea? But secondly, how has your work with Agora Partners evolved? Because when we first met 5 years ago, you were very focused on raising investment capital as the tool that was going to create the conditions for transforming the communities in which you work. And I think your work has now really broadened to an understanding that just investment and just impact investing isn't going to be enough. And so what else is necessary in the communities you work, and what has it taken for you to figure that out?
Yeah, thanks. So when I was at Columbia, which was not that long ago, but it seems like a lifetime ago, and certainly this industry has changed so much. We had a theory of change about development, and our theory of change was to focus on early stage entrepreneurs who were creating social and economic value in their communities as the single most important kind of unit of analysis. Because if you could get the entrepreneur to be successful, all kinds of incredibly powerful spillover effects happened. And we decided to focus on the second poorest country in the hemisphere, Nicaragua. And that was because my co-founder, Ricardo Terán, who is here actually, lives in Nicaragua. And we wanted to focus on places where we had really good leadership that could help us with this. And we figured out pretty early on that providing consulting support to entrepreneurs just wasn't enough. And so we decided, well, they need growth capital. There's no way that we can get them growth capital right now, so we'll create a fund and try to get a bunch of crazy investors to sort of buy into this idea of experimenting with an early stage fund that would invest in 5 to 10 companies in the second poorest country in the hemisphere. We have made 9 investments with that fund, and we've learned an enormous amount. And what we've learned, to make a very long story short, is that the problem is increasingly not lack of access to capital. There is so much capital now that is coming into the market. The real problem that we found for early stage entrepreneurs in very poor countries, and our focus again is Central America now and now Mexico, the problem is lack of quality deal flow for investors. And if you look at that from the perspective of a social entrepreneur, the problem is that it's very difficult, we as a society, we find it very difficult to surface really good talent and then to connect that talent with a web of social capital, human capital, and growth financial capital that they need to succeed. And so we've decided to sort of abandon raising another fund and instead to focus exclusively on identifying the best entrepreneurs and figuring out a way to, in a very efficient and systematic manner, put them into a program that will accelerate their chances of success and therefore their chances of getting investment. And so that is our focus right now as an organization.
Steve and Rick, is this, in your experience, would you agree that capital is not the binding constraint, and has that changed over time in the markets in which you work?
Ben's story is interesting to me because very early on in SJF's evolution, and you know about this, we focused on the fact that, so we all know the sort of the metrics in venture capital. You look at a couple hundred deals, before you invest in one. So we very quickly focused on from the impact side, and you need to do that from the return side, but from the impact side, what about the other 99+% of the companies out there? Some of them we don't think will be successful, but many of them we think will, and they just don't match up for us for a myriad of reasons. So very early on, we decided to focus on efforts to help the rest of those groups, that other 99%. So we set up a not-for-profit that's grant funded. It's now called the SJF Institute, and it does similar things. We run the Clean Links events in New York and elsewhere. We have things like Expert Network, where Bruce Usher, if he's around, and others are involved. And it's sort of, we felt like we were leaving a lot on the table to not do something with that other universe of companies that we were seeing and interacting with.
I think with respect to East Africa where we're investing, look, there's, it depends on which part of the kind of capital cycle you're talking about. So there is a lot of equity capital that's available for large-scale investments, infrastructure, extractive industries, and so on. And Africa's become, as the rest of the world or the West has gone ex-growth, Africa is sort of the final frontier, and so it's becoming a target for a lot of investment. Increasingly, there are a lot of funds that have been raised around the missing middle, what's called the SME finance. Most of those, though, are focused on expansion capital. So proven business model, bank finance is very expensive, need equity capital. So there are a lot of funds that have been formed in that space. I think a lot more capital being raised rather than deployed yet still. But that's, you can see that coming. I think where we still see a real scarcity of capital, and I agree with what Ben was saying, it's not just the finance, it's all sorts of capital that's required, is at the venture stage and at the angel stage. And I think there's a real scarcity of capital there. It's obviously riskier and it's more difficult, and you go to talk to the development finance institutions and they'll say things like venture capital is impossible in Africa. So you just got to focus on expansion capital. But there are real opportunities there. So that's kind of where we've focused on the earlier stage because we see that as a bigger gap.
Right. So I think this conversation is exciting, but it's also very abstract. So I'd love for you guys to get back to this question of, where have you, through your own experiences, put money to work or seen money being put to work in an impact investment which meets that standard of additionality? It's an investment that would not have happened unless an impact investor had a social purpose. But tell us about a specific deal, because I think it's very easy for this conversation to be abstract. A deal in which that impact investing capital both was necessary, would not have come from the market, but was also an appropriate investment to make. And then tell us about how that capital was put to work to generate both financial return, if that's been realized, and also social purpose. And how do you, or the investor in this case, think about measuring that social purpose? And if you have more than one, that'd be great.
I could start. So we're working with a company called CO2 Bamboo in Nicaragua. The entrepreneur is a very experienced engineer, and he saw an opportunity to build low-income houses out of bamboo in Nicaragua. He has created a technology that creates basically a modular bamboo house, which can then be very cheaply and efficiently built. And his main market is development agencies that are coming in with disaster relief and building 200 or 300 houses after a hurricane, that kind of thing. Haiti, of course, is a huge market. Now, the social impact of this kind of company is absolutely enormous because there are 20 countries in the world where you have bamboo. 19 of them have a bamboo industry. Nicaragua does not, even though it has some of the best bamboo in the world. So there is enormous natural resource that is renewable and sustainable that is not being tapped at all because no one has figured out how to add value. He's created a way to add value in a way that not only creates jobs for very low-income people, because a lot of people have to be involved in this industry, including actually building the house, where you have to, he trains people to build a house in the communities in which they live. And the margins are very good for this business. There's a huge market. The carbon footprint is much, much better than traditional cement. On every single level, this is a great business. And yet, this guy cannot get capital because people think, oh, you're too early stage, you're Nicaragua, the banks, he has contracts, but you have to have certain guarantees, you have to have certain reserves in order to sign the contracts. And so for someone like that, capital is a huge constraint. But he also needs a good accountant. He needs a lot of other kinds of support. And what we found, and for those of you who were at the keynote in the morning, which I thought was a really interesting conversation, you're starting to hear this concept of social capital and networks more and more, and how ultimately the business that we're in is a people-driven business. It's really about people developing other people. That's what this is all about. And so a guy like Ben Sanzerbel, this entrepreneur, he needs not only access to investors, but also access to a community of entrepreneurs. And through our accelerator program, I think this guy is going to get about $700,000 in institutional, strategic, impact-focused capital. And that is going to make all of the difference. And I don't know if we had not been there, if he would have, I mean, there's so many entrepreneurs out there right now trying to raise money. And it's, even though there's all this buzz about impact investing, for many very high quality entrepreneurs, they're getting incredibly frustrated because they're not seeing the VCs taking any risk. And in part it's because there's just not enough angel investors in our sector.
Well, SJF, having been around for almost 12 years now, we have had a lot of exits. If we hadn't, I wouldn't be here, and I wouldn't be talking about raising another fund for sure. On the clean tech side, we do energy related, we do alternative energy, and we do energy efficiency and infrastructure deals. But the segment that really I think sets SJF apart is the reuse recycling. And we were always focused on it partly because Dave Kirkpatrick came out of that industry, but also gets back to the point you made earlier about sort of getting away from zero sum. Where can you produce an additive to be additive to the economy? And reuse recycling is a great example of that, because if you're diverting things to a landfill, you're really not you're not replacing very many jobs as one guy running a bulldozer or whatever, and you're creating hundreds and thousands of jobs in sorting and distribution and so on, refurbishment. We've built and sold many reuse recycling companies. Cleanscapes was just sold last week, in fact, to Recology in San Francisco. A company called Salvage Direct was sold at a very attractive venture return a year or so, or a year and a half or so ago. Probably our most exciting company, not to jinx it, but David Greist down in Durham, this is very glamorous venture life he leads. He's been out for years walking the floors at the trade shows in the electronics recycling and other recycling trade shows as the only investor there, I'm here to tell you. And reaching out to companies, and he's now involved in a company that has finally figured out how to do cell phone recycling. A lot of people have tried, no one's done it very well. It's a company called ERC, and it's a fantastic model, and one even though, and it's very global, but it has to be a domestic business, by the way, because we're the country that subsidizes the purchase of phones. So if you bought a phone for, what did you pay, $50 or something for your iPhone or your BlackBerry, that's the $400 product. And when you get your new one in a year or two, the way we do, that's worth a lot. And they'll give you, with this model, they'll give you a credit. And maybe for $100, that means a lot to you, but they can sell it. We can sell it. ERC can sell it to emerging markets for, at a very nice margin. Reuse recycling, I think, is where most of our success stories have been, both on the return and impact side.
So it's just to push you before I let Steve come in on this. That company, I think Ben made it clear why the bamboo company is not going to be invested in by the mainstream markets. Why would a company like this need an investment partner like SJF? Why can't they just go, if they're that compelling, to the mainstream venture firms or to the banks?
Well, I think that is probably where we depart from maybe some elements of the impact model. Our deals are going to happen because they're good. Their venture is efficient, and our trick is to match up with them. What entrepreneurs want to do, when we talk about SJF, we talk about this alignment advantage, because so many people today want their jobs to involve some kind of positive impact. So a lot of times, that is the key to our getting into the company. But, they say, well, we like your values. We want someone like SJF involved with our corporate governance. But at least as important as that is, you better know how to help them succeed, because that's really what they want to do. And so SJF develops this deep domain expertise. So these are companies that we're going to get financed, but we're going to, we help them, I think, in a unique way.
Well, I'll just pick on one. So we invested in Paradigm Kenya this last year. Paradigm Kenya is a fuel-efficient cook stove distribution and carbon offset or carbon trading business. And they're now selling a range of 3 stoves in rural areas in Kenya. When we invested, they had about 3 months of sales, very early stage. Would others have invested? Well, they were out trying to raise capital. They were trying to raise $3 million of capital, struggling to get, they had friends and family and friends of family friends and so on that they were raising money from. We came in, took the largest minority, still a minority stake in the business, but came in to help them complete that raise. A lot of you will be very familiar with this. Most people kind of mainstream are not. A woman cooking over 3 stones in a pile of wood is the equivalent of smoking 40 cigarettes every time she cooks a meal. I think the World Bank says 1.9 million people die every year from indoor air pollution due to cooking smoke. So there's a big health benefit. They're still wood-burning stoves at the moment, so these are saving half the fuel and therefore saving time and money. And each stove cuts out 2 metric tons of carbon dioxide equivalent per year. So there's a kind of tree saving, carbon saving. There's an environmental impact as well from this. So I don't know if that answers it, but I think the risk profile of that was such that it might have been difficult to get commercial capital, or was difficult to get commercial capital coming in. What I would say, though, is now that business is now running at twice the pro forma financials. It's really taken off. That when they go to expand into East Africa, we may well attract mainstream capital. And for me, that's a win, right? I think people need to kind of re-rate the risk perception of Africa and some of these ventures. And hopefully we will see mainstream capital coming in into these deals.
So just changing tack slightly, I want to pick up on 2 things that Ben and Rick, Ben, you mentioned that this is really about a community. It's not just about an individual investor finding an individual company, but it's about building networks. And Rick, you talked about the fact that you're operating now in a very different context than you operated in '99, that partly there's buzz around the language of impact investing. But I've also heard you guys talk about some of the hype and some of the sense that there might be a mismatch of expectations between all the people out there saying that they're going to be impact investors and the language about it, and the reality that great entrepreneurs with great businesses are still not finding angel investors or even the next layer of investors to invest. And so I just wanted to, in terms of your own, you've all been doing this in different places and for different amounts of time, but how do you see the context changing, and how has the language of impact investing either helped or frankly hurt your ability to do your business? And can you play this forward a few years and let us know, where do you think this is going in terms of, do you think it's going to be a fad that people should start spending their afternoons in beautiful courtyards because it's something that's not going to be really having traction, or is it going to have traction? If it does, what's it going to take to get there?
I can start if you like. We're out, as I mentioned, we're out raising the 3rd fund, and so we're getting feedback from the field on what people think of what we're doing and what this whole impact investing thing means to them. And let me sort of approach it by, I think the bottom line is that as you look out forward, I think the outlook is very positive. And here's one of the reasons I say that. Start it with the banks. We don't know what's going to happen with Graham Dodd. We don't know exactly what the Volcker rule is going to look like, but for now it looks like the banks will get an SBIC investment will be a safe harbor, and Sean Green at the SBA has this Impact SBIC initiative, which is a great thing, and he's a great guy, and the banks are really very excited about this. And I've talked with banks that say we're only going to do impact SBICs, which is kind of interesting, kind of nice. So that's very good. Another category would be the family offices. So how are they reacting to this? I don't think we've met with a single family office that hasn't said, we're getting a lot of, I'm talking about family office advisors, that hasn't said, we're getting a lot of questions from our families about impact. What is impact? How do we get more involved in it? Now, the only thing there, and this is why we have to talk about, as you asked, 5 and 10 years out, it's usually the current young generation that's asking the question. So it may take a little while longer, but they're all interested to learn more. And then the last category is the fund of funds, which is the hardest for any fund to crack. And even that outlook is, I mean, well, they really want to see the numbers. Show me the numbers, and then they'll be convinced, but they're always very slow, and they're a final close investor, and very cautious. But they have meetings, and they want to see the results, and they're interested in tracking it. So I think all that says, and things change, but all that says to me that impact investing domestically is going to grow and grow rapidly.
Yeah. And to save everyone a Google search, SBIC is the Small Business Investment Corporations. It's a program that's a $100 billion program in the U.S., the Small Business Administration, that for a few decades has been promoting small business investment and development around the country. And the program that Rick mentioned is a really dynamic entrepreneur there named Sean Green, who said, while it might have been additional 30 years ago to be supporting any small business, we actually want to focus our support on those small businesses that are intentionally trying to target impact. And I think that's an example of how this language is starting to challenge people who've had a mandate for decades to put money to work in ways that are good for the country, to really raise the bar on what that means. And a similar program at the Overseas Private Investment Corp, whose new leader has used impact investing to similarly challenge her staff to think about what it means for them to be using our public money, although they don't actually take our money anymore, they make money. But they have a mandate to put money to work to help move capital into poor countries, which when they were founded in 1971 was good enough. And now their president is challenging them to say, actually, it's the subset of those companies that are really trying to create impact that we want to see your money targeted toward. So sorry to divert, and would love to hear your thoughts on the original question.
Yeah, I mean, I think another way of reframing that question is to ask, at what point will we be able to get entrepreneurs to think about how to create shared value in their business from day one when they're designing the business, and to put a kind of multi-stakeholder approach into the very DNA of their business, and to feel that there is a whole community that is going to support them around that. And investors are obviously part of that community, but they're just part of that whole ecosystem that has to get built. So I think that this is really all part of a broader movement, and it's going to require the media and consumers and ultimately entrepreneurs during their day-to-day decisions to really make it kind of sustainable and long-term. So impact investing, I think it's been a very effective framing of what many of us are trying to do. I think it's a very big tent. Maybe it's too big. There are lots of kind of academic discussions about that aren't that interesting to me. But my kind of focus is how do you take a lot of the energy around this that we have in this room and bring that to parts of the world where you don't have strong ecosystems. And that there I think for very little money you can actually have an enormous impact. And it's not just about kind of measuring impact, it's also about getting traditional entrepreneurs who might be able to attract traditional quote unquote capital to get them to actually change the way they do business. And we're seeing that. And that, I think, is how you get the system change that we're going to need to create a more sustainable capitalist system, frankly.
I mean, the only things I would add really are to say, I think that there is a danger of having impact investing being this kind of really popular, sexy label that everyone wants to kind of brand themselves as that. So I think there's still a lot more talk and there's a lot more hype, and I could be at a conference virtually every week on something. I get invitations to things. If people are at those conferences all the time, then they're definitely not doing any impact investing. So I think there is a lot more talk than action still, but having said that, I think that's okay. I think that you could say, well, then it's all smoke and there's no fire. But actually, I think we're at the beginning still of what is still a very nascent movement. And the kind of macro thing that I would just highlight is I think over the last 3 years, we're reaping the whirlwind of kind of the folly of short-term profit maximization. That, that's that idea that has driven a lot of our investing and a lot of our capital markets. I think the crisis, as much as it may have constrained investment and capital, will actually prove to be a long-term catalyst for impact investing, and call it inclusive markets or shared value or whatever language you want to put around this. But people are now starting to apply different criteria to the way that they're treating investments. And I think the real driver will be when we have vehicles that are set up that allow everyday ordinary citizens to be putting money into vehicles that are doing impact investing. Right now, it tends to be the purview of people who can play in the VC, the institutional and quasi-institutional money. But I think funds of funds and publicly listed vehicles and all of those things need to be built out that allow people to play in those, and that's where the big money is for this. And I know most people would like to, instead of getting 0.5% on a CD held for 2 years with a bank they don't trust and they don't like, would prefer to put their money into a vehicle that might get 5 or 6 or 8% and get a quarterly report on the social and environmental impact of their money. So I think that when we see that happen, the flywheel's kicked in.
Mm-hmm. Well, one other point I could make on that I think has some bearing on the future of impact investing, and I guess it's kind of obvious, but we need success stories, and I think particularly success stories where the impact element of the investment was responsible for the financial success, and we have one of those on the other side. I mentioned we do tech-enhanced services. We invested in a company where one of the underlying themes on that side of our program has to do with worker engagement, and we invested in a company called Ryla, and it's in the call center business, which is a killer business. Lots of companies have died in that. It's very competitive. It's a very high operating leverage. And so this may be an example of one that wouldn't have gotten funded without us, but we liked what he was doing. He was a minority CEO and team, but mostly what we liked about their plan and the way they did things was that they got their workforce involved. And if you know anything about call centers, they spend a tremendous amount of time training their employees. So if there's high turnover, they are going to do poorly. It's guaranteed. So here was a case where his philosophy of worker engagement, and they all did very well in the exit where the investors did well. His way of bringing everyone into the fold contributed to his being successful, running the campaigns better, landing bigger contracts, growing more rapidly, doing a better job for his customers, and ultimately serving all of his stakeholders.
So thanks so much. We're going to run short of time, and I suspect some people have questions. Do we have a hand mic? Is there a hand mic here? So if everyone has a question, we're going to take a few questions just rapidly, and then I'll ask the panel to try and respond in a synthesized way. So if you have a question, if you just raise your hand or get yourself there. But I know some of you aren't going to make it there. Who has a question? Okay, can we start right in the back next to the mic? If you can just grab the mic and ask your question. 2 rules: say who you are and where you're from, and ask a question, don't give a speech. Thank you. And we're trying to do it rapidly so we can at least get to a few of them.
Hi, my name is Franklin Moore. I work for the Queens Economic Development Corporation. We're a small local economic development corporation. But my question is actually on impact investing. There's, we know about some of these publicly traded companies who got a bad rap for basically wanting to maximize profits, and they forgot their social mission, right, specifically in microfinance. But there seems to sometimes, that's the question at hand, that sometimes what they were set out to do to really create a benefit socially or environmentally that you could measure, the financial bottom line got in the way. Is there something that, I know that right now people are talking about these B corporations, specifically domestically, or new legal structures to really uphold, I guess, that social bottom line. I guess I just wanted to hear your take on that, if you think that that's something that shareholders would buy into, or if it's something that is just really, you maintain the same legal structure and and just uphold certain bylaws in the processes by which you do that work.
Okay, great. We'll take that. And then right there, you're right by the mic. Yeah, thanks.
Hi, my name is Alex Osei. I'm from Guggenheim Partners. I have a quick question, and it's about basically raising money. An example is Mo Ibrahim. He had a Celltel, and he was trying to raise a couple of millions, and he had a problem. He couldn't raise it, but just a few months later, his company was bought by Zain for over $2 billion. What can be done to, to help such a good company who was just trying to raise a few millions that couldn't get, but a company from Kuwait could just come in with, funding from Goldman Sachs and buy it out for $2 billion.
Great. So could you take the mic off the stand and try and get it down to here?
Oh, okay.
Or is it stuck on the stand?
Oh.
Ah, perfect. Thanks. Over here, third row. We'll take two more, and then I'll ask the panel to respond. Probably not everyone will respond to everything, but yeah, go ahead.
Hello, I'm Daniela Jamekin. I'm with Agora Partnerships. And I'm interested in knowing, particularly Steve's and Rick's, but I'd love to have Ben answer as well, the actual execution. Because I know that you're based in the US, is that right? But you're working with countries in Africa. And how do you execute the services and support and finances? Do you have a local office? Do you work with partners? How do you actually work with these entrepreneurs? And well, yes or no, and then how do you do that?
Okay, great. And last one over here.
Hi, I'm Kara Hayes. I'm a master's student at GW in International Development and also work at Winrock International, which is a development NGO. And so my question is that, the development industry and the impact investment industry are really working towards the same goal, but with very different tactics and using really different language as well. And I was wondering if you could comment a little bit on either the success or lack of success in working in partnership with traditional development actors, government, NGOs, et cetera, and what has made successful partnerships successful and where you see the sort of gaps.
Great, so we'll cut it off there. So the four questions from Frank in the back, the question about what do you do if the financial bottom line and the social mission aren't actually aligned and companies might not find pursuing both to be an equilibrium point? Are the moves around new legal structures one way to try and stabilize the pursuit of both? The question about what is it going to take to get companies like Mo Ibrahim's company funded at the early stages, that's Celltel, which at one point was the biggest cell phone company in Africa, which when he was raising his first round of finance, couldn't get finance from anyone. Third question around execution, I think we've been a little abstract, so I appreciate the question. It's nice to say all these things, but how do you actually find companies, help them grow, especially when you're sitting in geographically away from where these companies are? And then finally, the question about how do we interface with development actors? I think that's really important. Impact investors don't operate anywhere alone. Everywhere we operate, there's government, there's the Small Business Administration in the US, there's development finance institutions operating abroad. And so I think that's a great question about how do you see impact investors working alongside government and other nonprofits, and are they doing it well, and what is it going to take to do it more effectively? So I'm going to ask each of the panelists to take one of those questions, or maybe two, but no more, and then we'll be able to wrap it up. Thanks.
Well, I can partially answer one of the questions, and that has to do with how we attempt to execute. And we're domestic, but the way we operate with industry specialties, it would be hard to also be limited geographically. So we're a national fund, even though we're relatively small. We have offices in North Carolina, New York, and San Francisco. Which again would be a lot easier if we had one office, but we need to do that because when you're out talking to people about venture capital, they talk about, especially when you're a specialist, they talk about best of breed company. We want to do the best of breed company in the country no matter where it is, so we have to spread ourselves very thin, and it requires a lot of extra work to do that, but it's necessary.
So the question about working with government and working with traditional aid funders like USAID, in general, I think that the people who work at USAID are wonderful people. I think that I think that the system, the system by its very nature is quite corrupt, really, and is not effective at all. And I've been saying this more and more, but development by definition, these are complex systems, right? We are working with lots of different partners and actors. We have to lower transaction costs, which means working with a lot of different people in a very strategic way. And you can't, you don't know how to do that when you start. You have to iterate, you have to experiment, you have to be willing to fail, and you have to learn. And nobody knows how to do this when they start. We certainly didn't. That's why we changed our model, because we figured out what was working and what wasn't working. And the problem with the development, official development approach is that you have a contract which is designed from the top down. Usually it's designed by marketing people in Washington, D.C., who have never even been to the country. And then you have to implement it. And so you're implementing these like 3, 4, 5-year plans. I mean, it's like the Soviet Union, and it doesn't really work. So we sometimes work with other, I mean, we're funded by AID, partly.
Not for long.
You were funded by AID.
Well,
I want my money back, Ben.
well, I will just say this, because we're talking about it really quickly. We were funded for 3 years by AID. And we did something that you're not supposed to do. We said, well, we actually have a lot of extra money because we actually negotiated at the hotels. We actually, we acted like entrepreneurs, not like contractors. So we actually have a full year of money left. So they extended our contract for another year. So we gave them a free year of impact. But that's not how the Beltway Bandits run their business. So all of that free year is absorbed in overhead and whatnot. So, well, don't get me started on this one.
I think we did. So real quick on the execution question, so we're active investors, so we have a seat on the board. In one case, I'm on the executive committee, so we're interacting a lot by phone and by Skype. I'm traveling in the region a lot, as my partners are, and we have local networks, local partners who are also helping us help support the companies. So you're right, it's not a kind of fly-by-wire, fire and forget model. It doesn't work in this space. I want to kind of work back up, and this isn't meant to be a flippant answer, but the Zane question around CellTel, if you look at the investment performance of a lot of the big emerging market funds, like Emerging Capital Partners, Development Partners International, they all had CellTel in their portfolio, and that's what accounts for their massive performance. If you really unpick their portfolios and ask what accounts for their performance, which has also helped, by the way, to attract a lot more capital into Africa. So I would like to think that the next Mo Ibrahim is having less trouble finding capital, but as I said at the outset, there still is that gap at the very early stage where it's just always difficult to come up with capital. And I suspect that's as true on Sand Hill Road as it is, it's truer on Sand Hill Road than we'd like to believe as well. The sort of fiduciary responsibility and this issue of social versus financial, yes, there are these, there's the L3C, the L3C, which in theory allows you to kind of make it a fiduciary responsibility to have the non-financial impact and make the board accountable for that and so on. I think all those things help, but look, at the end of the day, if you don't have the financial performance, you don't have the social performance, right? So our first screen always is the fundamentals. The business has got to be able to work as a business. And so at the end of the day, I understand you can have mission drift and so on, but I'm okay with the idea of saying, let's make sure we've got a sound business here that's generating profits. And ideally then is not a zero-sum game. You can get the social impact because of the products and services that are being generated by that business or being distributed by that business. And I realize it's not as simple as that, but it feels like it needs to be said that we've got to have the one. We can't have the other.
Great. So I think we're running out of time. Just to take a few more minutes and to ask the panel in 1 minute to tell us what is the question you wish you were asked, and either answer it or ask it of another panelist.
Okay, I won't ask you guys a question, but I wanted to weigh in on the question actually that Ben was addressing before about working with development agencies and so on, and the people who are sort of in more the aid business. And it's from a slightly different angle, but one of the challenges, so one of the big challenges I think in the impact space is you've got investors now converging on this space that have very different investment objectives. And so I'll just give you a very live example because otherwise it gets too abstract, right? So we looked at a company, we did our diligence on a company that had a real potential to scale in sub-Saharan Africa, and I won't describe it in a lot of detail because then you might be able to guess who it is. We then did our valuation of the company, and we're kind of VCs, so we did the valuation. It needs to make sense. And then a development finance institution came along with a big checkbook, right? And they wrote a term sheet for the majority of the capital raise that valued the company at 50% higher than we valued it at, because they didn't need to make a return, or they'd be happy if they just got their capital back. And what that did is it just took the deal completely off the table for us. And the structure of the term sheet also had some other issues associated with it. But I think there's a real challenge here now is that the space is, you've got people coming in from the aid side and the philanthropy side and people coming from the commercial side. And we're going to have more and more of these kind of collisions, right, where there are going to be hidden subsidies that happen that are going to exclude some deals where we may have been able to add more value to that company, frankly, than the DFI, who was going to fly by wire, but they were able to put a lot more capital in. So, and I've also got an issue with some of the technical assistance grant buckets that sit out there that provide basically a hidden subsidy to the management fees of some of the managers who have them, right? So you don't actually, the effective management fee for some of the funds out there are 7% or 10%, which no investor in their right mind would actually pay a fund manager for, but it's happening from a hidden subsidy. So there are a myriad of issues in there that are around the kind of subsidization in this space.
The question, I don't know if I wanted to be asked this, but I'm a little surprised I didn't, is Solyndra. So as an energy investor, what happened at Solyndra? How could the government have made such a mistake? And should they be subsidizing solar? Yes, they should be subsidizing solar just to make it at a level playing field with all the subsidies of nuclear and and fossil fuels. So that's not even a starter. But did they do something wrong? And the answer is no. Welcome to venture capital. We're in the business of predicting the future, and so every investment is a bet of some sort. Solyndra bet that silicon prices would stay high. They bet that they would continue to have a competitive advantage in installation cost. And hey, they weren't right. It happens every day in venture capital. What the government didn't do right, in my opinion, is they should have done more, and they should have done it sooner, because China will own clean tech.
The question that I would have liked to have been asked is, how can I help Agora Partnerships?
What's your wire instruction?
And the answer is actually, if you come to the reception tonight, we're actually going to talk a little bit about ways that people in this room can actually get involved directly in using your networks, your knowledge, your skill set to help really incredible entrepreneurs in Central America and Mexico to become successful and create impact. But I would also like to ask Antony a couple questions, because really he needs to have the last word. This is a historic moment, and so I have 3 questions that I would like to ask you.
I'll do them in 1 minute total.
Number 1, what was your proudest accomplishment at Rockefeller Foundation? Number 2, what was your biggest failure or disappointment in your 5 years? And number 3, what should all of us in this room, when we think about impact investing, if there's one thing that we can take and remember and think about, what would it be in your opinion?
Well, I am someone, Steve, who has gone to a lot of these conferences instead of being an investor. So I know to answer the question I wanted to be asked, not the one I was asked. So thank you, Ben. Those were great questions. I'll sort of answer. I think, again, in 1 minute, when I think about what I've been doing for the last 5 years, it's not me at all, it's my team. First of all, as Rick said, impact investing is not 4 years old. The rhetoric is. This is something that I stand on the shoulders in anything I do of the people who for decades around this table and in this room, and Josh Mailman is a legend, he's in the front row here, and frankly, for the people who for hundreds of years before that basically pushed forward the idea that how we engage with our capital and the businesses that we work with and invest in should not be completely detached from our values. That's something that the Quakers were talking about in the 18th century. So we haven't invented anything. We've really helped to bring together ideas that have been forming for a long time. But when I think about my work at Rockefeller, I think the biggest mistake I made, which is also the biggest opportunity, and it's really what our book is about, and that is, when I began the work, I really thought this was about product development. I thought it was about getting some funds out there, getting some deals done, building the IRIS, what's become the IRIS measurement standards work, the GEARS rating agency. So my biggest mistake was thinking I was in the product development business and not realizing I was in the systems change business. And I think Ben has been very articulate on this panel and the whole panelists that ultimately we're not just about, and this goes back to your last question, what should people in this room do? Once you realize that we are part of a systems change agenda and that all of this is a somewhat technical way of describing something far more exciting, and that is a fundamental change in the way that we as societies seek to organize ourselves to deliver a decent and just world to our children. That's what we're doing here. And the ways we've sought to do it the last 50 years are not up to the task of the current challenges. That's the work we're doing. That impact investing, on one hand, is absolutely about doing deals and getting funds done. But on the other hand, it is fundamentally changing these systems that exist that tell us that we have to separate how we think about investing our money from how we think about solving social problems. And so, what we try and do in the book is talk about what that systems change agenda is. We don't have a lot of answers in the book, but we really try and provide a blueprint for what are the systems that are going to have to change. The educational system is going to have to change. The legal system is going to have to change. How we organize our capital markets is going to have to change. And so I think my biggest mistake was not figuring that out early, but I think now it makes me realize we're not in a 5-year product development journey. We're in a 20, 30-year systems changing journey. And what's exciting about that, to your question of what the people in this room can do, is you can do anything, because wherever you sit, you've got a role to play in a systems changing agenda. That's not true if you're just talking about product development. If it's just about product development, then unless you're a great investor with a set of skills and a family situation and a set of interests that allows you to be in a fund, you don't really have much to say about a game that's just about fund management. Whereas if we're talking about systems change, wherever you sit in a system, you are part of why the system is the way it is. You're not simply someone who, human systems are things that we all participate in and change. And so I think it's incredibly exciting. And don't seek to answer the question, what does the movement need me to be? Start from the question of what is it that I am good at and what will allow me to be effective and true to myself. And in a systems change agenda, there's going to be a role for you. So again, I'm 3 minutes away now from ending my career at the Rockefeller Foundation, but I'm only at the beginning of the broader systems changing work that's going to involve everyone in this room and millions of other people if we're going to meet the needs of our time. So, thank you. Well said.